Okay, chapter 3, we keep moving on our topic about consolidating those financial statements. Now it is not just at the date of acquisition, though, it is after that acquisition. So obviously more stuff is going to be included. So here we have kind of what we talked about last time. We have a purchase price and the book value of the sub. They paid an extra $500,000 in those acquisition accounting premiums. What it related to was property, plant, and equipment, a patent, and then the remainder going to goodwill. Now we add this little column over here. Now we've talked about it in chapter 1, but we have to remember that when we add value to our books, our consolidated books, they have to be depreciated because nobody is recording these in the parents' books or the sub books. These are, again, like I said, they're top side. They're on top of the financial statements to create the consolidated statements. So we have to now record the depreciation and the amortization in our consolidating entries. And then when we follow our equity method of accounting, we are, again, initially setting it up as the equity investment. And then when we record their income, so we own them 100%, we're going to increase that equity investment, increase the amount that we had it set up for, to record all of their income on our books. And that goes into the equity income as a credit, and again, increases the investment. Then when the company, the subsidiary company, pays dividends, in a sense, it's a return of that equity income. So we do not record dividend income. We receive the cash and we reduce the value that's in our equity income. So think of it as a return of part of that $210,000. So we're reducing it by the money that they gave us. Now then we're going to record the depreciation. So a lot of times when I do these on the board, I'm going to take the subsidiary's net income, and then I'm going to subtract the depreciation to get to the equity income, and then I just would have done it in one entry. But the textbook likes to show you it step by step. So this represents all of the subs income, the dividends paid, and then this represents a reduction of that income equal to the amount of that additional depreciation and amortization. So we're going to reduce the equity income, and then we're going to reduce what we put into our equity investment. So again, we're kind of reversing A, but just for the amount of the depreciation and the amortization. So then in that equity investment account, we'll have our beginning balance, what we purchased the subsidiary for, the equity income. Now they have netted it when they show you in there. But be careful on the home, let me flip back. So be careful on the homework, I've gone too far, because they may want you to do it in these separate entries like we have going on here. But if you look at the 210 less that 27,500, that is what this 182,500 represents. And then, to be honest, that's what I like to do as well. But in the homework, they might like baby step you through it, so just be careful. But then that creates our ending balance in the equity investment. So then now we have 3 new journal entries. So again, we had our A entry and our E entry in chapter 2. Now we're adding the C, the D, and the I. Actually, the I will come in the next chapter. So in chapter 3, it's really just the C and the D. So then you can see, though, like I said in chapter 2, all of these entries continue. So if you don't understand C and D now, you're never going to understand them in those future chapters. So focus on them and try to understand what these are. So our C entry is going to relate to the subsidiaries, or that equity income from the subsidiary company, and then the dividends paid by that subsidiary. We are going to eliminate those. The D entry is how the acquisition accounting premium assets get depreciated and amortized. Because like I said, they're on the top side. They're not on the parents' books or on the subs books. They're on the consolidated books, which are on top of it. And then chapter 4, we'll get into those I entries. So this is a good little acronym here, and it's a good understanding. If I were you, I'd print that out. And it also is nice, it gives you the code as well as the color coding that I expect whenever you're doing it in Excel to use that. So we already had our E and our A. E eliminates all of the stockholder equity accounts of the subsidiary company at our beginning of the year value. Our A, so that's going to pick up, that's going to be important in this chapter. So notice that what's italicized, it's our beginning of the year balance, not our end of the year balance. Our A entry sets up all those acquisition accounting premium assets. Now the C entry is going to eliminate our equity income and our dividends paid. Our D entry depreciates all of the assets in the acquisition accounting premium computation. And then our I entry, again, when we get into chapter 4, is going to eliminate any intercompany activity that goes on between the parent and the sub. So again, that C entry deals with those changes. The E and the A is what is in that beginning balance. And then the D entry doesn't go into the equity investment at all, which is why we don't see it there. And then here shows you, again, another page you could print out to have in front of you. So I know this class is going to be challenging. Anything that you can have in front of you to help you with the homework and the tests, I would print it out. But this gives you an example. I mean, again, the dollar amounts obviously change per problem, but these are the accounts that we use. So in our E entry, we debit our common stock, our paid-in capital, our beginning of the year, that BOI stands for beginning of the year retained earnings. The credit always goes to the equity investment. The A entry sets up those acquisition premium assets. So again, they could be different. But these are common ones: property, plant, and equipment, patent, goodwill, could be other intangibles, and then the credit goes to equity investment. The C entry debits our equity income for whatever's on the parent's books, credits dividends for whatever's on the sub's books, and then the net credit goes to our equity investment. And then our operating expenses are going to be a debit to operating expenses and a credit to the accounts that they are associated with. And again, no intercompanies yet. But again, that's a good reference point to go back to and to kind of understand all of those. So here again shows you the consolidated financial statements in the first year following the acquisition. So notice now we're not just looking at the balance sheet. So chapter 2, we were just looking at the balance sheet because it was at acquisition day. Now we're a year later, so we've got income, we've got the statement of retained earnings where the net income and the dividends go into and out of. So then now it's definitely more complex. So now that it's more complex, it's even more important to separate those entries with the color coding and then to understand them so that you know that you've got your debits and your credits. So the E entry, we're eliminating common stock and paid-in capital just like we did before, but now that we have the statement of retained earnings, we're eliminating that beginning of the year retained earnings. So that's $775,000. And then the entire credit goes to equity investment. We set up our acquisition accounting premium assets with a debit. That entire credit goes to equity investment. We eliminate all of the equity income, eliminate all of the dividends paid, and those net into our equity investment. And then we notice our equity investment is now zeroed out. So that minus these 3 entries equals 0. Also notice our equity income zeroes out. So our equity income less that adjustment brings that down to 0. Then we have our depreciation to record, so we're going to debit our operating expenses with that D entry, credit accumulated depreciation into the property, plant, and equipment net, credit the patent, and then again notice that our consolidated net income equals our parents' net income, our consolidated statement of retained earnings equals our parents' statement of retained earnings. And then if you come down to the equity accounts, the common stock, paid-in capital, and retained earnings also equal the parents. So those are all of our double checks. So again, this is a nice one to look at, understand how it's set up. understand how to color code these, and know those double checks. And I do have those out there in Blackboard, so you want to look at those as well. Now, where it gets a little bit more complex is the years following. Sorry about that. The years following. So where it gets into the complexity is the acquisition accounting premium assets. So if we're depreciating those, we have to go to what is our beginning of the year balance. So when we're in year 2, this property, plant, and equipment is being depreciated $10,000 a year. So our unamortized balance at the beginning of year 2 is $190,000. So it's no longer $200,000. We reduced it by the $10,000. If we were in year 3, it would be $180,000. So I mean, every year we're moving past the acquisition, it's going to go down by another year of depreciation. The unamortized patent the same way. Started at $175,000. We amortized it for 1 year, so it takes it down to $157,500. Next year, it'll go down to $140,000. Goodwill is not amortized. It's looked at to see if it's impaired, but we do not amortize it. So then that's really the main focus. Now this kind of again tries to map it out to you. I kind of do it a different way when I work the problems out. So look over the way that I do it in the problems. I think it makes a little bit more sense. But then here is the journal entries. So we're still eliminating our common stock and our paid-in capital and our beginning of the year retained earnings, and that offset goes into our equity investment. But now we're setting up these acquisition accounting premiums at that beginning of the year value, and that goes into our equity investment. We are still eliminating our equity income, all of the subs dividends paid with that offset going into the equity investment, and then we're still depreciating at the same amounts. So while the amounts change, the process is still the same. The one thing you just want to focus on, the real thing that's different, is those A entries. So just cognizantly look at the problem to say, how many years have I depreciated already at the start of this year? The reason it's the start of this year is because the D entry records the depreciation for this year. So we want to go back to January 1st. Okay, then our statement of cash flows, I don't ask you to prepare that, but there are some things that you just want to know. It's this similar thought to like our income statement and our balance sheet. We're not just necessarily adding these up. We are going to prepare our statement of cash flows from the consolidated income statement and the consolidated balance sheet, same way that we would a regular cash flow statement, but we have to add back the depreciation of the acquisition accounting premium assets, as well as the ones that the parent and the sub have booked. And in the year of acquisition, the price that they pay to acquire that subsidiary company would be a cash outflow in the investing section. And then our changes in working capital would be the same, like looking at how do accounts receivable change, cash change, all that stuff. But we would exclude the effects of the acquisition itself, because those changes would be included in this cash paid in the investing section. After the years after that, we would just look at the changes in the consolidated balance sheet and prepare the statement of cash flow. Now, we talked about goodwill, and we said it is not amortized. So at the end of the year, they look at it to say, well, should it be impaired? Is the goodwill still at a value that is realizable or has value to the company? So the first step that we do is we look at the fair value of the company as a whole, and then we compare it to the net book value of the company as a whole. And if the fair value is higher, then we're good, because the net book value includes the goodwill, so we don't have to worry about it. If it's not, then we go to step 2 and we look at the fair value of the net assets of the company as a whole, and then compare that to the fair value of the company. So the net assets, fair value of the assets, fair value of the company, and then whatever that difference is, we're going to compare that to our goodwill value. I mean, and I think this step 2 doesn't say it in here, but I believe it's excluding the goodwill. So just the fair value of the assets compared to the fair value of the company, again, excluding goodwill. And then whatever that difference is would be the value of goodwill. So if our goodwill on our books is higher than that, then it would be impaired. If it's not, it would be fine. So if we put numbers to it, sometimes that's easier to understand. So our carrying value on our books of goodwill is $125,000. The fair value of the reporting unit is $1,700,000. The fair value of our net assets, excluding goodwill, is $1,600,000. So then the difference between the fair value of the company as a whole and its net assets is $100,000. So that's the maximum that goodwill can be valued at. So then we go to our books and say, we've got it valued at $125,000. So we need to impair it by $25,000. On our consolidated statements, it would go to impairment expense and it would reduce goodwill. This is showing you that on the parents' books, they're going to reduce their equity income and reduce their equity investment, which will bring the equity investment down to its value. And then here's a summary. Again, you do want to understand the equity method of accounting. So again, that was introduced really in chapter 2, but then now we're eliminating it. So you still have to understand kind of why it's in that equity investment account. You definitely want to understand those 5 entries, and then know that in those first and second years, we're going to the beginning of the year value. And then how do you actually prepare the consolidated statements in good form? Again, look at the codes and the color coding. And then understand goodwill, that we don't amortize it on an annual basis, but every year we will test it to see if it needs to be impaired. So that is chapter 3.